Testing. 1, 2, 3, testing. Gold. Good afternoon. It is Thursday, April 10th, 2025. It's 1 p.m. on the East Coast, 10 a.m. on the West Coast. And this is Rob Sin at CEO Technician on X, at Goldfinger on co.ca. And you're watching Goldfinger Capital. Some of the trends that we're seeing out there, some of the market price action, especially in gold and gold miners, has me making this video on this Thursday. Obviously, we all know the last week has been really wild, really insane across markets, just the headlines. I'm not going to go into that. But I do want to point out some important things to note. Very important. Gold. So we're currently at 31.75, traded up above 31.90 earlier. Everybody can see this hourly chart, this V bottom. This is literally what a V bottom looks like in the textbook. The tariff day, the liberation day, gold trades above 3,200 briefly, then proceeds to drop over $200 an ounce by Monday morning, back to 29.70, and now here we are back at 31.75 on Wednesday. So that is a V bottom, and even that $200 an ounce drop, which was obviously pretty violent, was not it was actually a pretty strong $200 drop. And what I mean by that is the fact that gold's still trading near $3,000 an ounce, while the treasury market was bordering on blowing up. And obviously we saw what happened with stocks. I don't need to recite all of that volatility, but a 5 or 6% drop in the gold price when S&Ps are down 20% and the Mag 7 are down 30-40% plus, I would say that is a resilient asset class. That is a sign of strength. And when we put everything into perspective, when we zoom back and look at where gold has been, to have a pullback basically to the 50-day moving average, not even to the 50-day moving average, the 40-day moving average, and basically retesting the previous highs from February, that is extremely healthy. And the fact that that was it, that was the extent of the correction, that is strength. Gold really flexed its muscle and proved its mettle over the last week, quite frankly. I don't really have much to say on the equity markets other than they're volatile, and cut your size down big time if you're going to engage this market. But the gold price action is really noteworthy. And the data that we're seeing, still, it's lagging data. The CPI is looking at March. Obviously, a lot has happened in the last 10 days, so it's stale. But even the fact that the CPI came in so cool, missed to the downside for March, I believe really increases the odds of a Fed rate cut in May. I would say it's really 50-50. I know the market doesn't agree at that point, but I would say May is 50-50 at this point. And the longer this uncertainty maintains itself, I mean, if we stay with this level of uncertainty for the next 3 or 4 weeks, then May is definitely going to be a rate cut. I don't see inflation as the problem here, even if these tariffs stick. I know everybody's worried about it. Inflationary, it's more likely to result in demand destruction, which is not inflationary. It's actually more deflationary, I would think. And it's certainly negative for economic growth. It's certainly likely to raise the unemployment rate, which the Fed is much more likely to care about. The Fed is much more likely to see any one-time price increases as transitory. The tariffs are one-time price increases, right? But anyway, there's so much in flux there. But the reality is that the strength of the economy has been jeopardized in the last couple of weeks. I think we can all agree on that. And that means that the Fed is way too tight at 4.5%. when CPI is running below 3%. The Fed is way too tight. So I see 100 basis points of rate cuts coming down the pipe here fairly soon. And, you know, when we look back at history, when we look back at early 2016, when we look about back to March 2020, even, Q4 2008, these were times when we had tremendous rebounds and rallies off of major lows in the gold miners and in the junior miners. Now, I wouldn't say we're at the lows in gold miners, but it wasn't long ago, actually December 2024, that we were at the lows. So we're literally 3 months off the lows in the gold miners. And in the junior miners, you could still say we're treading water at the lows, really. I mean, just look at the TSX Venture. But when we look back at history, some of the biggest moves, some of the biggest rallies in this sector, again, January, February, March 2016, March through August 2020, November 2008 through 2010. These were times when the Fed was behind the curve, the economy was relatively weak and decelerating, and the macro uncertainty was really high, right? And the Fed cut real interest rates sharply. And that's the situation we're in right now. So I believe that this really is a sweet spot. And some people might look at the GDX chart and say, well, I missed it. No, you didn't miss it. This is not missing it. Okay. This is just coming off of a major bottom. Okay. This is not missing it. And, let's zoom it out even more. Let's go monthly. Let's go all the way back. Let's go 20 years. Same place we were 13 years ago, right? This is not missing it. And then contrast where the gold price was then, probably 1800, to where it is now, almost 3200. You haven't missed it at all. Okay. You have not missed it at all. Not one bit. But so let's look at Newmont breaking out, right? So just running through some minor charts here. Newmont reports earnings April 23rd. So that's less than 2 weeks from now. And this is likely to be a stellar Q1 with raised guidance for 2025. And yeah, I mean, this has had a nice move this week, no doubt about it, but that was after dropping pretty sharply at the end of last week. But this is a breakout. This is a V bottom, and I don't see any reason to overthink it. Stick with the trend, stick with the breakout. IM Gold as well. And this is a real sweet spot for IM Gold. The fact that this company is ramping up its production, it's a producer, it's a mid-year, and they have the 70% interest in the Côté Gold project in Ontario, which is now about to be one of the biggest gold mines in North America, puts them in an enviable position. Okay, so the fact that you get production growth with leverage to the gold price is really nice. I mean, IAG is in a really enviable position. Just look at where the stock was 4 days ago, guys. 4 days ago, guys. Like Monday morning, you could have bought this on the NYSE at 535, right? So this market is serving up some real opportunities for those who are paying attention. And frankly, while there's been a lot of macro volatility, there's been a lot of market volatility. If you actually understand these companies' businesses, I don't think they have really been affected adversely by all this turmoil across markets the last couple of weeks. I think it's business as usual. And in fact, if anything, margins just keep getting bigger, keep getting wider. Oil price has fallen, right? Hate to say it, but the fact that labor market has balanced and rebalanced so much in the last couple of years, and certainly here at the beginning of 2025, due to all the macro uncertainty, means that it's a better situation for a gold mining company to find labor and to find labor at a more reasonable cost, quite frankly. So look at these margins. It's impressive, right? So even companies that are in the highest decile of the all-in mining cost curve, somewhere near $1,700 or $1,800 an ounce, still has massive profit margins at 31.72 gold price, right? Massive profit margin. And producers in Canada with a weaker Canadian dollar are in even better position, quite frankly. And even though the GDX is up and it's one of the best performing sectors in 2025, it's still not keeping pace with the increase in gold miner cash flow per share. This chart from Garrett Goggin, he does some really good charts on this gold miner cash flow. You can see the sector is still trading at a 20% plus discount. So it's, if you actually understand the fundamentals and you understand the macro trends and the growing margins, the widening margins, not just the fact that the margins are really juicy today, but the fact they're getting even juicier, then this sector is not even close to fair value. It's still very much under owned. And this also from Garrett Goggin also puts into perspective, like, look at this. The total shares outstanding of the GDX continues to fall. So this means that investors continue to liquidate the GDX. Right? This is not, I mean, look at what happened in 2020. Yes, so the gold mining sector came into favor a little bit in the second half of 2020. You can see shares outstanding of the GDX rose. Well, since then, since the beginning of 2021, basically, it's done nothing but decline. Okay. Yeah, and a lot of people say, why aren't the juniors following the gold price? Well, that's a multifaceted answer, but the simplest way to put it is that the people who buy gold, the central banks, big institutions, sovereign wealth fund, don't buy junior mining stocks under $1 billion market cap. They just don't. Some of them don't even buy Newmont. Obviously, central banks don't buy Newmont, right? So there's a different set of investors for junior miners, and it's a much smaller pool of investors. So that's one reason. Another reason is the fact that financial conditions are still pretty tight. Like we just talked about, the Fed funds rate is 4.5%, while the CPI is whatever, 2.6 or 2.7%. So we have positive real interest rates still. So the Fed is still very much pushing down on inflation and on the economy, quite frankly, right? And obviously, what's happened the last couple of weeks in terms of the tariff and so uncertainty and the macro backdrop is just, it's not like that level of uncertainty is not good for financing venture capital companies, right? And so those are the simplest ways to explain why the junior mining sector is not tracking the gold price so far, right? But that being said, look at IAG. Obviously, this is not a junior, this is a mid-tier, but it's had a fantastic 2025. It's had a fantastic last couple of years, quite frankly. And then when you move down the food chain a little bit into the junior producers, right? So these are the small producers with production, let's say under 100,000 ounces of gold per year, or they're just literally starting to ramp up right now. This is where the real torque could be, quite frankly. This is where you could see some outsized gains, right? If the Fed does what I think it's going to do, which is cut interest rates a lot, gold price stays strong or gets stronger, this is where you could see some real gains here in 2025. So I chose 4 to highlight. Heliostar Metals. This is now a producer, but it's definitely a junior producer. Not a whole lot of production. I'm not even sure. I think it's 20, 30,000 ounces a year, but they have visibility to much larger production over the next couple of years and potentially getting that high grade Ana Paula project up into production again. That could be really where there's a lot of blue sky for Heliostar shareholders. Then there's Integra with Florida Canyon in Nevada. And then they have 3 main projects, if you put them all together and they all get into production, you're looking at well over 200,000 ounces a year of annual production. So that's the blue sky here, and that's the upside of these companies, right? Where you're in a strong gold price environment, a rising gold price environment, but then also you put in the potential of growing production profile, and that really is a sweet spot where there aren't a whole lot of companies that are in that sweet spot. And so I would say that Heliostar and Integra are two that are in that sweet spot, and it's all about execution on their end to get those projects into production and to be mines, right? Talisker Resources has Braylorn in BC, which is basically one of the highest grade or the highest grade gold camp in Western Canada. Nice chart. You can see it definitely come off of those end of 2024 lows. The share price doubled, and they're gradually moving Braylorn back into production. So you're talking about almost 2 million ounces, high grade. You're talking about grades of 10, 11, 12 grams per ton there at Braylorn with a very large footprint, right? Look at their deck, look at their claims positions across BC, massive, absolutely massive, both in Spence's Bridge and Braylorn, and then another project called Ladner in southern BC. So this is an interesting company, right? Because yeah, they're about to be a producer, a high margin one at that, right? Like the margins here are going to be more than 50%. But they have a lot of blue sky on the exploration side, so that makes it quite interesting to me. And then West Red Lake Gold moving into production at Red Lake this year. And you can say this is a bit of a disconnect right here. There's obviously some things going on at the corporate level. There was a financing the market thought was unexpected. There's a little bit of selling from a large shareholder who was an owner, an investor in the previous operator at Madsen, right? There's a lot of moving parts here. It hasn't really tracked the gold price strength, right? But really, at the end of the day, for a company like West Red Lake, it's execution at the project level, at the mine site level, that's going to move this forward. They need to prove to the market that they're going to make this work and that Madsen is going to be a profitable mining operation, right? And so that's really where there could be a lot of upside here in 2025, these junior producers. Thanks for tuning in. And if you enjoyed this video, please like and subscribe.